Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call, coming to you live from the CNBC-TV18 Motilal Oswal studios. Much more settled handover from Wall Street, not very much big. It is ongoing discussion between US and China, and that's the big story. Of course, apart from what's happening in Los Angeles, in America, where there's a National Guard on ground. Almost sounds like a episode from. What was it? House of Cards, guys. I don't know. It's just crazy stuff.
And not just the National Guard, now US Marine. 700 Marines also deployed.
Yeah.
And it's all happening.
Well, indeed, and extremely fluid scenes out there. And in fact, you don't know what's going to happen next. So, just hope that normalcy, rationality returns all across the globe.
Absolutely. A lot of conflicts, a lot of things erupting, and really a bit of a state of upheaval. We've been sort of in that kind of phase now for the last at least a few months, if not more. Well, let's just take it from the top then, and we'll come back to this in a bit because, as of now, markets is this important story, and I think it's going to get a lot of press, but markets, are they paying attention yet? We'll find out. So, the big story, of course, is the US-China talks which were held in London, which were held in UK. Not very much by way of detail has come out. US equities, though, drifted higher. As they awaited news around specific details, etc., equities were slightly up. NASDAQ ended about 0.3% up. The 10-year yield was down 3 basis points. The dollar index was down about 0.13% as well. So, again, really no indication in that sense from the US close across rates, dollar or equities. As I said, US-China trade talk details were limited from yesterday. But, you had everybody from President Trump down essentially saying that it was very fruitful, very good. So, for example, Commerce Secretary Lutnick said trade talks were fruitful. Treasury Secretary Scott Bessent said it was a good meeting. And I think there's President Trump himself on the record kind of saying, well, it's not easy, but he's expecting good things. Bloomberg, there was a story which essentially it was very clear that, and this is what it said, the US is willing to remove restrictions on some tech exports in exchange for China easing limits on rare earth shipments. And this is the real thing. I think there was, after that Geneva handshake deal between US and China, I think there was some misunderstanding about what China is expected to do or willing to do as far as rare earth is concerned. And I think those restrictions those restrictions which were imposed in April were not eased. And it's kind of led to this latest flare-up. But of course, the question is, what many are asking is, who can afford to wait more? Can China afford to wait more without the chip technology? Can US afford to wait more without rare earth, which is used in everything from automobiles to defense to renewables, etc., etc.? So I think it's a bit of a mini test, right? Trump and the top Trump team have said for a long time that what we're trying to do, America first, will entail short-term pain. But is the electorate prepared for these disruptions? I think in that sense, it's a bit of a mini test which is going to be closely watched. So talks continue today as well. And I think we'll figure out if there is any detail which starts to come through. A breakthrough will be significantly positive as far as markets are concerned. I also on the fisc in the US Treasury will sell about $58 billion worth of 3-year notes today. So it's an auction. US budget development should also be watched closely. It's got to sort of go through the motions, get passed before it becomes a act. If it's solidified. Oil prices, they were up another 1%, 67 plus on oil is what we finally had. Now, to circle and tie in the levels here, so Nifty momentum continued yesterday, although we spent bulk of the day just under the upper end of the range, which is 25,116. Only twice, around 11 and 12:30, and of course the opening, we got above those levels, but otherwise spent the entire day under that level. That should, I guess, get taken out. But 25,116 is the upper end of the range we've been waiting for the market to take out. Immediate resistance after that is 24,310, which is nothing but the 78.6% retracement of the entire decline that the Nifty has seen. And support comes in at the 40-hourly exponential average, which is 24,872. Again, very near-term levels, just under 1% on both sides. The Bank Nifty inched higher, and of course, the momentum there as well. Weekly upper Bollinger Band for the Nifty Bank, which should act as a bit of a resistance, is 58,183. Support comes in at 55,508. You know, it's a question I asked yesterday whether we will see a repeat of what back then FMCG stocks saw after the tax cut announcements, rallied, Lever, etc., rallied sharply and then fizzled out over the next 10 days after the budget tax cuts. Will we see something similar after last Friday's RBI cut announcement and some of the big moves? We've had 2 days of decent moves as far as financials are concerned. And maybe today, over the next 2 days, I think, we'll find out in terms of how much fuel is there in the tank for markets to bid these names higher, especially in the financial space. GIFT Nifty, quick check in terms of what we are opening up at. It's a 60-point uptick on the GIFT Nifty. So comfortably, like yesterday, above the upper end of the range. And then maybe further to go. Surabhi.
Yeah, absolutely. I mean, not too much going on. It's just global markets have been inching higher slowly but surely. And whatever you throw at them, issues around trade, issues around politics in the US, come what may, markets have been marching higher and that continues. In fact, they're doing better now because there's some hope that there could be some breakthrough in this US-China trade deal. So that's what's keeping the excitement alive. By the way, yesterday we got the Chinese import-export data. While overall for China in May, exports were still up 4.5%. There's specifically their exports to the US, obviously for obvious reasons, have been taking a hit. In fact, they're down almost 34.5%. These are China exports to the US. So let's watch for the developments around this space. Most markets are higher. I mean, if you're looking at mainland China right now, the Hong Kong market, or you're looking at Japan, all the indices are tracking a gain of 0.25% to 0.5%, if not more, depending on which one you're looking at. And the South Korean market continues to charge higher. Consecutive gains coming in. Even the Kospi is up about another 0.5% today. We'll watch for, of course, what happens to crude oil because it's building on that move above 67. Technical chartists are saying there's a bit of a technical breakout as well. Crude has been in a range after falling, post-Liberation Day, and it's getting close to the top of that range now. So whether it breaks out on the upside, we have to see. But look at that 0.5% gain coming in above $67 to the barrel that's on Brent. US politics continues to be in focus as well. It doesn't have an immediate market bearing, but markets are, of course, watching and taking note. I mean, is it leading to more instability? The state of California has now sued the US, Trump administration for the use of the National Guard, for the use of troops on the streets in LA to quell the protests. And let's see how that plays out. And in addition to the initial call for the National Guard, there were 700 Marines deployed yesterday. Now, President Trump is saying that there'll be 2,000 additional National Guard troops that will be pressed into service. So things are pretty dire from that standpoint. For us here, the positive consolidation has continued and the market is right at the top of the range. The Nifty yesterday took several attempts to cross the previous high, which is 25,116, but it couldn't do that decisively. Could today be that day because Qs are still positive. So let's watch for that. Flows are very supportive, no problems there whatsoever. FII has bought cash market equities worth almost 2,000 crores yesterday. Domestic institutions were also buyers on, about 3,500 crores. The flows are not a problem. And with the kind of, small opening pop, we'll again be breaking above the recent 17-day trading range. Let's see if we can sustain there today or not. Lots of, interesting stock action. There's plenty of paper supply that's hitting the market, whether it's blocks or OFS, rights issues, etc. Premier Energies is going to be in focus because, sources have been telling us that one of the key funds in the company, the South Asia Growth Fund 3, that could be selling over 5% equity via block. Capri Global, and this is Nimesh was telling you this on D Street Chatter on Closing Bell yesterday, got confirmed. Indeed, there is a QIP coming. They're looking to raise about 2,000 crores as well. Nigel will talk more about Protean. There's finally some good news coming in for Protean as well. And I'll also place the defense pack on the radar again. There are lots of reports doing the rounds that the Defense Acquisition Council could be looking at procurement of surface-to-air missiles, the quick reaction surface-to-air missiles. And the value of the contracts could be 30,000 crores. So Bharat Dynamics in particular, which is a key systems administrator, integrator. That would be in focus, and even a BEL. So watch for the defense pack if it gets excited on some of these prospects as well. So Nigel, looks like we're set for a positive start today.
Well, that's right. But I think the headline index will be in a bit of a range, and the real action will continue in the broader markets. Maybe we console a little bit, but there'll be select stocks that will outperform, and that's what we have been seeing. Even in yesterday's trading session, the real party was in the mid as well as the small cap index, which outperformed what the Nifty did. Even the Nifty Next 50, that as well did pretty well. So the broader market traction will continue. However, enjoy the party, but just take on board that the margin funding book actually has moved up. Remember, when the markets got very, very buoyant, it went closer to around 90,000 crores. Then when the markets, went into a bit of a tizzy, we saw a lot of those margin calls got triggered, and that's why that book had come down to around 65,000 to around 70,000. As of the last count that's given on the NSE, it's uploaded on the NSE, it comes with a bit of a lag. It's at around 81,000 crores approximately. So that margin trading book actually has moved up a little bit. So, it appears that there is some leverage that's creeping back into the system. For the time being, it looks okay, but just keep an eye out on this number as well. Moving to what happened on the headline index yesterday, there was a bit of a short covering bounce that played out. Indices ended higher and the open interest was lower. And what did the FIs do? Not too much on index futures, though they continue to remain net short with close to around 80% of their positions on the short side with regard to the FIs in yesterday's trading session. And we should get that graph up for you on the screen as well. 80% positions still on the short side. Moving to the options data then, there appears a bit of a strategy playing out because in yesterday's trading session as well, the 25,100 call, 25,100 put, both of them were fairly active. You club the premium, it's roughly around 300 rupees. Now that's telling me in the near term, just in the near term, we could be in the 600-point range, which means on the upside, the 25,400 mark becomes a bit of a resistance zone. On the downside, the 24,800 becomes your reference zone. And that's where the 20 DMA as well ballpark comes in at. The near-term resistance, though, will be at around 25,250. So for the near term, 25,250 to around 25,400, that'll be a bit of a band in terms of a resistance zone. The Nifty Bank, that'll have to lead the way. Remember, the RBI governor, has given them that bit of a booster shot with regard to the CRR cut. And on a day-to-day basis, gradually you're seeing it's making, higher highs. You'll want to see this trend continue because the Nifty Bank will require a bit of a push to get decisively past that 57,100 odd mark. I'm looking at two stocks. Both of them have got badly hit. One is Protein eGovern. They have won a 100 crore order coming in, from Bima Sugam. So I'll keep an eye out on this stock. Remember, it got hit when it didn't qualify for the PAN 2.0 contract. But there is some good news that's coming in there. And it's a stock that's down 30%, I think, in the last month or so. So that one is on my radar. And the other one is Jindal SAW. Remember, crude oil prices have perked up a little bit. After a while, they've gone ahead and announced a capex in the Middle East. This stock as well is down 30% in the last 6 months. Putting on some capex, that'll give you some visibility with regard to growth. Stock trades at around 5 times EV upon EBITDA. And as I said, it's been a big underperformer. Growth was the problem, 30% down. It was high yesterday, but it could be one of the stocks of the day today.
All right, keep an eye. Jindal SAW in focus there. Well, Nigel, thanks very much for that. Lynn Alden is founder at Lynn Alden Investment Strategy. She's with us now with some perspective on market. Lynn, good to have you with us here. Thanks very much. A lot of the stuff is kind of similar, not very much change in terms of news flow or markets really, but how do you view these protests in the US? And, it's another kind of battlefront opening up in California. What's your sense, Len? Will markets start to take note, and are they already taking note somewhere? What's your sense?
I think U.S. markets would take note if they became more severe. I don't really view this as much of an issue for markets outside of the U.S. Certainly some U.S. problems obviously have very global reach in terms of their capital market impacts, whereas this one is primarily about U.S. political stability. If anything, if this deteriorates, it could give a bid to foreign assets. Here in the U.S., generally speaking, the markets tend to shrug things off unless they become very severe from a political standpoint. And so this is still a wait and see period. In general, this current period is kind of defined by headline driven markets. So the past couple of years, we're in very much liquidity driven markets, whereas here we're punctuated by headlines. Before it was tariffs. I think we're past the kind of peak tariff uncertainty, even though there are tariff issues going forward, whereas now we're moving into more whether or not they're going to pass the bill and in what form, and also these protests and responses over in California.
Lynn, with regards to US-China, who do you think, how How do you think markets will? What do markets want? I mean, the US wants these rare earth minerals, the supply to be opened up once again. China wants high-end chips. Although I think Kevin Hassett yesterday was on record to say that, well, we will provide some chips, but not the really high-end NVIDIA chips. Names like Qualcomm, etc., were up 4-5%. What's your sense, Len?
Yeah, so I think the markets want stability. They just generally want de-escalation, stability, clear sight. Obviously, the U.S. and Chinese governments want different things. Overall, I think China has the stronger hand here. And if this was happening back in President Trump's first term, it might be a different case. But they took a lot of preparation, China did, over the past several years. And so while they do have some weaknesses, like as you point, the very high-end semiconductors, generally speaking, the U.S. is more harmed by rare earth shortages, most likely, than China is harmed by shortages in the high-end semiconductors. And so the best case for both entities is de-escalation across the board. But I think the market's already kind of sussed out the fact that the U.S. has fairly low pain points when it comes to dealing with China. It had peak uncertainty back in April. And ever since then, it's kind of been understood that it's going to come and go. There's going to be ongoing frictions, especially for very import-driven businesses. But I do think we're past the peak level of uncertainty between these two, at least for now.
And maybe that's why the U.S. equity market, Lynn, it's been climbing every wall of worry, right? It's been such a great last 1 month. I mean, just the headline index, the S&P 500 is up 6%. Stocks have done even better. So where's all the chatter about rotating away from the U.S.? I remember when we spoke in March, you said that investors could be looking at more of those shifts, and some of that money moved to markets like, Europe. But what now? I mean, would you invest additional dollars back into the U.S.? Would you look at Asia, Europe? Where would you put the money?
I think the two most attractive markets are most likely China and Latin America broadly, Brazil and elsewhere. Those are probably the best long-term values that I think could benefit from ongoing capital rotation. Generally speaking, these capital rotation stories take a very long time to play out. They're not really done in a quarter or two, and they're usually not very sharp moves. And so I don't expect this one to be a sharp move either. And so going forward, I think basically the U.S. is not necessarily going to give up a ton of gains to the rest of the world, but I think it's going to be less of an outlier as it has been over the past 5, 10, even 15 years in many cases. There's very few markets that have been able to rival it. And I think when we look forward over the next 5, 7 years or so, the U.S. probably won't be one of the best performers. It could still very much be a top performer, and I don't expect major rotations out of it. But I do think that there are better values out there. And there has been still, even this year, even though there's been not any sort of sharp rotation, there's plenty of basing formations forming around the world, especially in some of those markets I mentioned, where I do think that we've seen the lows in those markets and that there's a lot of upside potential left.
All right. Hi, Lynn. Good morning. Always good to see you, Win. And I think your preference is for emerging markets over developed markets, if I remember correctly.
Yes, I think emerging markets have a better blended valuation and growth. I'm still somewhat skeptical of European assets broadly. So I would pick my individual emerging markets and developed markets. But on average, I do think that China, Latin America, and a handful of other places have some of the more interesting prospects going forward.
Well, Lynn, you mentioned growth, and the Indian markets are the ones that are offering earnings growth. I think the problem you have had is with regard to valuations. While the Chinese market, you have inexpensive valuations out there, but growth is not really picking up. How would you weigh the two, and at what point of time would you say, all right, India is a market that's in a structural story. You'd rather, start focusing out here as well, because the toss-up between the two, you're leaning towards China.
Yeah, I think you summarized it well. I mean, with China and Brazil, you're looking at value markets. You're looking at very inexpensive markets. I think they have really good ratios of basically what their valuation is compared to their forward earnings potential. India overall has obviously much faster growth. The ratio is not quite attractive. India's rarely ever cheap. And so I think it's one of those things where India's continues to be one of those buy and hold stories. You just continue holding the equity market, especially if you're an investor outside of India and you want exposure to that market. So it's rarely near the top of my list, but it's also rarely near the bottom of my list. Another way of putting it is that if we do enter a more prolonged kind of stagnation in the dollar index, so we get a little bit of an easier dollar, some of the more dollar indebted markets have a lot more upside leverage from that. So that would primarily be Latin America and parts of more broadly Southeast Asia, whereas India is relatively protected from dollar indebtedness compared to many other markets that are classified as emerging. And so they generally have a lot of protections. And that also means that there's less kind of downside priced in right now. So India, I continue to be a buy and hold long-term investor of. And just in terms of maybe a 3+ year performance view, I generally view Latin America and China as perhaps the most interesting kind of more contrarian type place.
All right, Lynn, we'll leave it there. Good conversation. Thank you very much for joining us. Appreciate it. Let me just quickly run you through what's lined up here over the next 2 hours or so. So 8:35, you'll hear from Karan Thorani of Elara Capital. He's going to talk about Rapido's entry into the online food delivery business and impact on peers. 9 o'clock, you'll have Kumar Rakesh of BNP Paribas. We'll talk with this call on the auto space. 9:20, you'll hear from Prateek Gupta of Kotak Institutional Equities. On markets, 9:30, you'll have the management of Chola Investment Finance. Actually, 9:30 to 10, it's all about the RBI impact, right? So you got Chola joining us on that. You got Jana Small Finance Bank joining us. And of course, they've also applied for the universal banking license. And 9:50, you got the real estate space in focus. Knight Frank and Tata Realty talk to us about what are the prospects and which specific geographies are things still looking good. Well, 10:15, special conversation with Soumyakanti Ghosh of State Bank of India. It's the economy, and Lata will carry on that conversation.
Well, time to slip into a short break, but we've got a lot of stock-specific action to track for you in a special Top 10 segment. For the time being, I give you a sneak peek into the list. Protein, eGovern, IRB Infra, ITT Cementation, Z Entertainment, Jana Small Finance Bank, all of them will be reacting to positive news flow. Add to the list NIBE, you have Jindal SAW, while on the flip side, you have Premier Energies, Capri Global Capital, and Vishnu Prakash that will be reacting to negative news flow. Take that break, come back, we get into further detail on all of these names.
Welcome back. So the cues across Asia are positive, and markets are up between 0.25% to 0.5%. Some are even higher. That's a broad picture coming up for you. And with all of this, the implied open has been telling us that we could start positive by almost 64 points. So there we go. Once again, we are going to be punching above the trading range. I keep going back. 17 to 18 day. Today is the 18th day of that trading range. Can we punch above it and sustain above it? That's the question for the day. Well, we'll get our answers in due course as the day progresses. In the meantime, let's focus on all the stocks that should be on our radar. And we have our team standing by with the CNBC-TV18 list of top stocks to watch. Guys, morning to all of you. Vinny, let me start with you. Which are the ones you're looking at today?
Hi, good morning, Surabhi. So a couple of stocks that I'm watching out for. Firstly, Premier Energies is what we're keeping an eye on. Expected block deal today where South Asia Growth Fund will be selling 2.5 crore shares. That's almost half their stake. So they were holding 11% stake in the company, 11.1% to be precise as on March 2025. Now they're looking to sell 5.5% stake. This is at a floor price of 1,051.50 rupees per share, which is at a discount of just 1% to yesterday's closing price. So the worry doesn't come in terms of the discount to the yesterday's closing price in terms of the floor price. That's not an overhang. The overhang comes in for the remaining stake sale. Will South Asia Fund be looking to sell the remaining stake as well anytime? So that could be an overhang, and that is why we are watching out and keeping the stock a bit in the red front. And we could see a recovery coming in, but red is what we're expecting it to start with. Next one that I'm keeping an eye on is Protein eGov. Now the company has won an order of around 100 crores, and this is for a 6-year contract with Bima Sugam. The contract is specially to build India's unified digital insurance platform. This will help the company build furthermore in terms of the digital public infrastructure presence that they have, as well as the long-term growth in insurance tech. Obviously, they had a lot of negative news flow that came in because of PAN 2.0 in the recent time. So we had seen a fall coming in. Some bit of a positive news flow. We could expect green on the screen today for the stock.
All right. Vinny in yellow going with green on Protein. Thanks a lot for that, Vinny. Let's hop across to Vivek. He's tracking tracking a few stocks in news. Vivek, morning.
Well, good morning. A few stocks on the radar. First on the list is Capri Global. We accessed the term sheet. Remember, the company is going in for a fundraise. So the QIP route is the route the company has chosen for this particular fundraise. The company is looking to raise up to 2,000 crore. The base size of this particular issue is 1,500 crore. The upsize of the green shoe option is another 500 crore. The indicative issue price, significant discount to yesterday's close at 146.5 rupees a share, implying that a little over 16.5% of total equity dilution is what the company will see. Now, the other stock on the radar is IRB Infra, came out with the May toll collection update, almost 9% increase as far as toll collections were concerned. The company says uptick primarily attributed to the vacation season across the country. They also did mention that pre-monsoon rains minorly impacted traffic volumes in the later half of the month. And lastly, ITD Cementation, again an order win coming in over there, order worth close to 900 crore. This particular order is for the construction of berth and breakwater for a greenfield captive jetty at Odisha. Remember, the order book at the end of FY25 stood at over 18,300 crore rupees.
All right. Thanks very much for that, Vivek. Well, let's talk about other stocks with news flow. Vamakshi is here with exactly that. Vamakshi, morning.
Good morning, Prashant. Let me first start off with Z Entertainment. Well, they've gone into a strategic partnership with a startup called Bullet to launch India's first micro-drama app. They will be acquiring a stake in the company. But however, they've not yet disclosed the stake as well as the amount that they will be investing. Keep in mind that the Bullet app will be launched within the Z5 ecosystem, and this is to enable a wide audience reach. Now, keep your eyes out on Jana Small Finance Bank as well, because they've gone ahead and submitted application at RBI seeking voluntary transition from Small Finance Bank to Universal Bank. So on the back of this development, could see some green on the screen for this company. NIBE will also be in focus because they've secured technology transfer license from DRDO. This is for modular bridging system, and under the terms of this agreement, the company is licensed to manufacture this critical system in India and sell it within specified licensing regions for a period of almost 10 years. And this also includes exclusive rights to supply the system to the IAF as well as some other government agencies. Keep an eye out on Jindal SAW as well, because they will be incorporating a new subsidiary in UAE. They will be setting up 3 lakh tons per annum seamless pipe manufacturing facility and will be investing somewhere around $105 million US. In addition to that, they've also entered into 2 JVs with its own subsidiary in the Kingdom of Saudi Arabia and will be investing a total of almost $13 million in both of these JVs. Lastly, keep an eye out on Vishnu Prakash R. Punglia. Expect red on the screen for this counter, because CARE Rating has downgraded its rating on the long-term bank facilities for the company to CARE BBB from, and the outlook is negative. They've revised it from CARE BBB plus stable. Largely, the revision is on account of continued longer periods of payment release as well as delays in work certifications, especially from state government bodies, impacting the liquidity profile of the company. So therefore, going with the red for this counter.
Okay, all right, got it. That's a long list, and we've noted down all the stocks, actually. Thanks very much. Let's quickly recap the stocks that have positive news flow around them this morning. Protean, eGovTech, IRB Infra, ITD Cementation, Z Entertainment, Jana Small Finance Bank, NIBE and Jindal SAW. The ones that have negative news flow around them are Premier Energies, Capri Global and Vishnu Prakash. Okay, well, with that, let's move on and also do a quick roundup of all the commodity market action. We have Manisha Gupta joining in with the latest as always. Manisha, good morning. What's on your radar?
Thank you for that. So we like equities, commodities seem to be doing quite well as well. 2 things that really seem to be working. One is the weakness in US dollar index, and the second is the markets are now looking at the US and China trade conversation moving in the positive direction. So that really seems to have led some interest here. I'll start with gold, which also seems to be supported by Russia taking control of more territory in Ukraine, easing, especially in the central regions, and that is what is adding premium to prices. But it really is about the other metals. Platinum gained up by 4% overnight. Palladium gained up by 3%. Silver is up 2% overnight, trading at a new 12-year highs right now. And we have seen similar gains come in for copper as well, 1.5% gains overnight. That one is trading at a 10-week highs. And there have gains that have continued in crude as well. That one is trading at a 7-week highs right now. So as I said, some renewed optimism over US-China trade talks really seems to be doing the trick.
All right, Manisha, thanks a lot for that. Well, time to slip into a short break. Up next, we'll connect with Prakash Diwan. He'll help us out with some fundamental stock talk. Later on, Karan Thurani as Elara Capital as well will be joining in to analyze Rapido's entry into the online food delivery business and its impact on the listed entities like Swiggy as well as Eternal. Stay with us. We'll discuss all of that in further detail. Welcome back. You're tuned into Bazaar Morning Call and hope you're having a good Tuesday morning. Well, we've listed down all the stocks that we're tracking, but help us out with further analysis. We have Prakash Diwan who joins us on the show. Hi, Prakash. Good morning. Good to see you win. I wanted your view, Prakash, on two stocks that have got absolutely slammed. One is Protein eGovern. That is down, I think, close to 30% after they missed out on the PAN 2.0. And the other one I'm talking about is Jindal SAW. Now, valuation-wise, sub 5 times EV upon EBITDA, stock down 30% again in the last 6 months or so. And now they've announced a capex that will help them, gives them some confidence with regard to growth. Your view on either of these names, both of them have got hit very, very hard. And now overnight, there is some mild positive news as well. Your take.
Good morning, Nigel. So I think I'll start with Protean. There you have, a setback which was absolutely unexpected. Now, the assumption of them getting the PAN 2.0 project was kind of penciled in, built in, was taken for granted to a large extent. But probably there's some issues because of which they've been kept out of the RFP process. And what is now happening is that the company is probably looking at levers to grow beyond just the PAN business, which is great as well, because there's so much that is likely to be happening in the digitization infrastructure space that the company will play a very pivotal role in all of these projects, which usually are sponsored by the government, but have to be executed at a very far, boots on the ground kind of an approach. So there is possibility that the organic growth will catch up. It's a great business, difficult to replicate, entry barriers, you have everything there. And I don't see any reason why you should look at it afresh at these beaten down levels. And very clearly make an assumption that PAN 2.0 doesn't come and kind of, change things overnight. But organically from here as well, closer to $1,000, if you look at a CAGR of about 25%, there's no reason why it cannot clock that. So it's good for the steady kind of, portfolios, but it's no fireworks at the moment. So, but I think the bottom has been made. The organic growth will kind of start playing catch up, and you'll probably forget about the setback. On Jindal SAW, this thing is very clear. We've looked at pipes before. We've seen how Welspun did so well because they had a very unique mix of domestic and international businesses to kind of support. It's already done about 40%, 30-40% from the time we spoke. But here you have a company that has built huge capacities, has done some good acquisition, the Srikalasti thing and all. They've built themselves up for a lot of business going forward. But there's somewhere or the other, there's growth, this thing. The growth has been anemic. We've not seen some levers, vectors support that. Probably this sets, the trend to in a different zone where you will start seeing some international exposure coming their way, which was missing. So I think the companies realized what was missing. They're trying to plug those gaps. Let's see. Of course, execution is always a big challenge in these kind of businesses because there's so many complexities in terms of order flow, execution timelines, and all of that. So we'll wait for that. But remember, these are JVs, so you will have a little bit of a diluted impact. These are not like 100% owned subsidiaries or something. So I would believe there's a turnaround that's imminent, but I would wait to see some numbers on the screen before actually buying into it. But Protean, I think, is probably a bottom fishing kind of a stock at this moment.
Okay, Protean. Let's see what kind of gain it manages to get and, if it sustains. Prakash, hi, morning. Speaking of turnaround stories, I think the market is looking for exactly that, right? Probably explains the kind of trading that's going on around IndusInd. Look at Bandhan. I mean, Bandhan has had such a rocky ride last couple of years. And now there's so much excitement with the RBI moves coming in. Generally, there seems to be a lot of excitement in tier 2, tier 3 lenders. Jana has put out an application now. They want to be a universal bank from a small finance bank. What would you buy? Any ideas? Tier 2, Tier 3 financials.
So, good morning, Survi. So, that space is always fraught with a lot of volatility in this, because the news flow can throw you off the mark in a very significant way. And a case in point, let's say, is RBL Bank. Just about 4 months back, RBL Bank was probably at closer to 150 or even lower. But look at how smartly it's moved. If you see somewhere around Jan, I remember, when things started looking ugly for them, there were a lot of revelations that came through. The calls, kind of brought in a lot of anxiety and fear, and nobody's been talking about it. But connect this with another data point, and that is M&M is looking at acquiring or adding to its stake in M&M Financial Services.
Yeah, I saw that. Correct.
Yeah, M&M has a lot of interest in RBL Bank since quite some time. It keeps coming in flashes. It's not something which is a continuous story. It's a developing story, as you call it. They're buying into M&M Financial. They're adding their stake. They've got a stake in RBL Bank. Somewhere, you'll probably see some corporate action around that, because this is very clearly, anecdotally, what sets the precedent for these kind of things. So I'm not saying that's a reason to buy, but I'm just telling you, you spoke about Bandhan turnaround, Jana Bank, of course, looking at, moving to the next level. Here's RBL Bank, which actually had so many issues, but it's moved from that 150, sub 150 zones to now, 225, 230, which has been done very quietly. So smaller banks will do that. I mentioned DCB the other day. It's kind of done so well. And this gold financing thing is actually going to help a lot of these small banks, whether it's CSB, whether it's South Indian Bank. But you don't just buy these banks for a particular, portfolio. You will need to look at them in terms of how strong the balance sheets are, what kind of growth they're sitting on. From that perspective, I think some of these still don't qualify. But if you had to take a tactical, exposure, some of these smaller banks that I mentioned DCB could continue to do well, given its focus on SMEs and, the way credit expansion could kind of help some of these niche players rather than the larger ones. So, of course, ICICI and HDFC and all continue to grow for their own reasons. But as you asked, from the smaller banks, mid-sized bank, I think this is the pocket to look at.
So DCB Bank and RBL Bank, with the caveats, are obviously not stocks for the faint-hearted, right? Those are the two
absolutely. RBL could still throw you off gear, so be careful. Right. But I'm just giving you this thing on how things have changed.
No, absolutely. And, with what else, Prakash, are you kind of doing? Sometimes, the thing is, any small good news, things are kind of finely priced, so you're kind of latching on to stuff, right? Even small positives, and market kind of bids up those stocks disproportionately. Not in the case of financials, which I think is the only more reasonably priced part of the market. What's your sense? Defense, for example, continuing news flow, and I think we're going to focus on this. We focused on it on the editor's playbook. You can catch that on CNBC-TV18 Access, which is, of course, our new offering. And we did a deep dive discussion. We're going to focus on it again this Thursday. But anything there or any other areas? I mean, these are spaces where you kind of sort of have a bit of a tailwind as well.
Oh, absolutely, Prashant. So, by the way, before I go into the stocks, I just want to tell you and congratulate you and the team for the CNBC Access, output. I think it's absolutely breathtaking. I mean, it's so convenient, so simplified, and so nice to use. I loved it. And I'm sure we'll hear more of that as well going forward. You need to look at defense. What's going to happen is there will be a set of headlines which will keep attracting attention, of course, for obvious reasons. But let's say the QRSAM order book, that's kind of likely to be unleashed, if I were to use that term. And we have big amounts being talked about there. Now, defense, as we saw, has kind of awakened from a sub 2% or sub 3% kind of allocation in the indices to almost going up to, expectation is to 8-10% in the next 10 years. So there is a secular trend. Now, what you have to do is look at smaller names which actually are going to be benefiting disproportionately because of their size, because of the base effect. And some of these companies that are more into electronics, more into work around the ecosystem, where you have drone technology getting more and more revised and upgraded rather than just shipbuilding and aircrafts and all. The warfare is not going to be artillery and ships anymore, as much as it will probably be driven by airborne techniques. So you will have to choose out of that. They will be the front runners. But we have a lot of catch-up and replacement to be done in the conventional defense equipment space as well. So that will keep happening. I can tell you, L&T, for instance, is probably the most underrated stock on the defense side. I mean, why I'm saying that is because it has a significant presence in defense from a timeline perspective and a quantum perspective. But just because for the size of L&T, the defense play is not very large, it doesn't kind of stand out. But the Pinaka rockets, as I keep saying, the launchers were done by L&T. They're doing so much of work. In fact, they're giving out work to a lot of other smaller vendors in terms of system integration and all that. And the day L&T starts kind of getting recognized for the contribution it has been making and what it can do, you'll probably have a very different multiple getting accorded to that part of the business. Of course, the other business, the core business also is doing so well. So I know it's not a very exciting sounding name to talk about in these markets where you keep looking for new ideas, but I would not give it to FOMO, but I would still latch on to something like L&T given its numbers and the future potential, and just ride this till the next new high is made. I'm sure you still have about a 10-15% upside from here for this name itself.
That's okay, Prakash, as long as the money is made, right? And they say often the biggest wealth creators are the most boring ones. No harm in being boring as long as it keeps the wealth multiplying, right? Just stay on. We'll have more questions for you in just a bit, and maybe we'll discuss this later as well with you. So quick commerce and food delivery once again in focus because it seems that competition is heating up. There's a new player lurking around the block, and we're talking about Rapido. This is a story that our colleagues had put out yesterday. Rapido has announced its entry into this segment. Now, how could this impact Swiggy, Zomato, if at all? We have Karan Taurani joining in from Elara Capital. Karan, great to have you on. This is the question that we usually keep coming back to you with, right? What happens if a new player decides to, unleash heavy discounting? What happens to those platform fees, right? It's not Amazon right now, but it seems to be Rapido. Your first thoughts?
Hi, Sylvie. Good morning. So the segment is quite dynamic. So, new players keep coming in, keep trying out. I think the food business per se right now is very different as compared to what it was about 5 years back. You saw very strong growth of more than 40% on a CAGR basis on GOV for the food segment, which is now converged to about 15%. And I think since the last 3 to 4 years, Zomato, Swiggy have got a dominant duopoly in this segment. So entry of a new player does come to be a surprise. There have been other players also who made an entry in the past in the likes of, ONDC, Tata Foods, and there have been some direct ordering platforms like Five and Dot who also made inroads. But the reason for these players not being able to achieve success has been because of no control on the last mile. Second reason has also been access to capital. Some of the smaller fringe players did not have access to capital to discount, to kind of gain customers, make the technology, get the app, in terms of better user experience. But what Rapido has got here as an advantage as compared to the other players who have failed in the past is the last mile, right? So Rapido has got a large, fleet of scooter riders all across the country, almost about 4 million riders. That's one advantage. They have access to capital. They have also partnered with Swiggy in the past and other players and also done food delivery on ONDC. So Rapido does have some potential to actually achieve success in the food segment. But as I always say, execution is key here. So unless execution is not done properly, unless the consumer experience is not enhanced as compared to how Zomato and Swiggy are doing right now in terms of the food delivery, you will not see Rapido scaling up.
Right. So, hi, Karan. Good morning. Good to hear your thoughts. As you said, Rapido, the benefit that they have is, they have rider network of 4 million, going through your note, and also they do many rides on a day-to-day basis. They've also raised some money, so they've got some money in the kitty as well. Do you think Rapido will be a challenger to Zomato as well as Swiggy, or do you think the space is large enough for another player to be taken into the system?
Had Rapido entered 5 years back, I would have said the space is large enough for another player to enter. But today,
yes, but now you're saying that the growth is much slower in comparison to the 40%. So I ask you, please go ahead.
Yes, absolutely. So I think because the growth rates are converging, if Rapido is able to execute well on 2 parameters, right? One is on the technology part and second on the consumer experience part, which means the consumer will actually make a move from a Zomato Swiggy towards a Rapido because of better consumer experience or on par consumer experience or because of discounting at the start. If that were to happen, you will see convergence in growth rates for the incumbents. And one has to really put into fact here that food delivery as a business segment has been trading at very premium valuations because of this entire this thesis that it's a duopoly market. You cannot have a third player really scale up. So now there is some fear that because of last mile, if at all a third player scale up, you will also see conversions in terms of valuation multiples. So apart from earning downgrade in the food business, there could also be valuation derating for the food business. So I think as per our sensitivity, the food business valuations in a worst case scenario for Zomato or Swiggy could be cut by anywhere between 15 to 20%, which means that on a consolidated SOTP basis, which means food delivery is 45% of the overall equity valuations, you could see an 8 to 10% kind of a downside in terms of their target price.
Okay, both Eternal and Swiggy.
That's a worst case scenario. If at all, Rapido executes extremely well and they're able to scale up to a reasonable amount of market share.
Okay, so just a couple of questions, Karan. For our viewers, how much cash does Rapido have, to be able to sort of sustain, because there's a lot of discounting in this space as well, right? We've heard from people who cover the space and people as well that Zepto, for example, has been very aggressive, and they have a lot of cash as well. So discounting is a big factor here. So how much cash? How long can Rapido sort of sustain this game, or is their strategy slightly different? Second is this execution business, because they already have riders all across the country, as you said. Is it the same? Is it on an actual basis, is the same technology on the app, or do they need to create something else, or are they already 60-70% there in that sense? Go on.
The first point in terms of cash and discounting, I think what discounting a new player would have to do 3 to 4 years back, it is going to be very different right now, because this segment is one of the reasonably penetrated segments in India today. We are not kind of going for consumers moving in terms of habit of online food delivery. That habit has largely been formed. So whatever quantum of discounting a Rapido will do today will be extremely low as compared to what these incumbents would have done about 5 years back. That's the first thing. So they may not require that much amount of cash as far as discounting is concerned. Second, I think in terms of the cash balance, they do have a FD cash balance, I think $1.1 billion when the fundraise happened in December 2024. So I think they may be able to sustain for another 6 to 12 months, and execution will be monitored constantly. Thirdly, in terms of the technology, I think, yes, they will have to, build a separate app for this. They will have to basically, integrate the food delivery service into that app. 2-3 things, the easiest part is tying up with restaurants, because restaurants today want multiple aggregators to partner with them so that their take rates kind of come off and they don't have pressure on margins. So restaurants will be more than happy to tie up with a third partner. That's the first thing. Secondly, to get this entire technology in place, consumer experience, that is going to be the key monitorable. I mean, why will a consumer today move from a Zomato, Swiggy to a Rapido? Will it be lead time? Will it be discounts? What will be the factors that they'll try to focus upon? That is the key monitorable.
Absolutely. Absolutely, Karan. And that remains to be seen, right? That's the real key, whether the interface, user interface, or whether it's going to be the discounting. But just to round this up, the point that you made about having more restaurant partners, is there any risk of a shakeout or a shakeup over there? Because in the past, we remember, Zomato went through a fairly turbulent phase where restaurants were up in arms with just the revenue sharing model and the commissions that were at play as they were partnering with some of these platform companies. I think what sources have been telling us is that Rapido could be looking at seeking lesser commissions from restaurants, or basically a better revenue share. Could that be a risk?
Yes, exactly. And that risk will only emerge once Rapido executes well, point number one. Second, if they execute well, they'll scale up. And that's when you see the pinch for Zomato and Swiggy. Okay. So we can't say that things are going to be worst for Zomato, Swiggy right now, because it's very early days to call out for. We'll have to monitor in terms of what are the kind of customer traffic, how many orders they're able to deliver, how many riders do they have, how the performance in the consumer experience. But yes, some dent definitely is expected in the near term.
All right. I think good times, though, for consumers, Karan, if we're going to have another player there. For shareholders, we'll have to see how things play out. Very quickly, we had an article that was just flashed that United Spirits could be looking at, selling part stake in their IPL franchise, which is Royal Challengers Bangalore. They're talking about around $2 billion. If you have any rough numbers, since I think you track United Spirits, Sun TV as well could be a stock on the radar if they're going to get some valuations like this. Do you think it would be realistic?
Yes, I think if you look at Gujarat Titans, I think last time around when the new teams had started about 3 to 4 years ago, the valuations therein were closer to $1 billion. And these are new teams which were not making hefty profits as compared to the incumbent teams which are there. So valuations for IPL teams have moved up significantly over the last 1 to 2 years. This has also been because of the IPL renewal right cycle about 2 to 3 years back. So yes, there is a possibility that valuations are closer to $2 billion, but $2 billion seems quite far stretch as of now, because I think as per our assessment, these companies are doing top line of anywhere between 500 to 600 crores. And if you assume a 40% PAT margin, you come to a number of 200 to 250 crores, which will not increase incrementally in a big manner until the next auction happens in the next 3 to 4 years. So I think putting that into perspective, I think a fair value is about $1 to $1.5 billion. But $2 billion could be slightly stretched. But yes, if you have somebody who wants to enter this business, you don't have too many teams to buy out. So somebody will definitely also pay a premium if you want to enter this segment and play this segment.
Okay, all right, Karan, thanks for that take. For United Spirits in their scheme of things, at a market cap of 1.15 lakh crore, where it could be relatively smaller, but for a Sun TV, at around 25,000 crores of market cap, if you get an IPL franchise of around $1 billion to $1.5 billion, it could be interesting times. Appreciate you joining in, Karan, taking us through the entire food delivery chain, and how you see that panning out, and also commenting on the IPL valuations. Appreciate you joining in. For the time being, though, we'll slip into a short break. On the other side, Sudarshan as well as Mitesh are waiting for us. Don't go anywhere.
Okay, welcome back. There's 6 minutes to go for the pre-open session to kick off. 67 points higher on the Nifty is what we have. Sudarshan and Mitesh are with us with what they want you to do as far as specific trades go. Gentlemen, good morning. Good to have both of you here. Mitesh, your thoughts first to kick things off. Momentum continued, but could not really break out convincingly above that 25,100, 25,116 kind of levels. Think a matter of time and we kind of head to 25,300 plus kind of zones, the 78.6% retracement of the entire fall?
Morning, Prashant. So I think, yes, I would maintain that while the Nifty was slightly subdued, and did not build much upon the opening gains, the Bank Nifty actually did quite well and, closed much higher. And both the indices, the directional bias remains on the upside, with the Bank Nifty already clear of the earlier swing highs of 55,800, 56,000 zones. I think the Bank Nifty is heading towards 57,500, in a good case scenario 58,000, and that could also propel the Nifty to about 25,400, 500 zones. So I would say positive.
Okay, so headed higher. So today, in that sense, Mitesh, what's the advice if you're trading the Nifty and the Nifty Bank?
You already have long positions, Prashant, over there, but if somebody wants to buy today, then post the gap up, I think, wait for a 20, 30 point kind of a decline. Keep a stop just below the levels of 25,100 and maintain your long positions.
Sudarshan, what about you? What would you recommend?
Yeah, good morning. Well, the recommendation has been to be on the long side of the market. And the market doesn't have to oblige us by, going 100, 500 points every day. We know that doesn't happen. The trend is more important, and the trend is on the upside. Now, yesterday we had a very narrow range day. Usually narrow range contractions lead to an expansion. Whether that happens today or tomorrow or day after, I cannot say, but I would expect the markets to have a decent, strong up move in the next 2-3 days. So today, the trade is, if you are long, do nothing, stay long. Your stops are still 24,800. If you are not long, look to go long on any minor consolidation or dip. Expect a breakout in the next 2-3 days.
Okay, all right, gentlemen. We want to hear about your stock picks as well. For the time being, though, we'll slip in a short break. We'll be back pre-open rates. We'll get the ideas coming in from Mitesh as well as Sudarshan. We'll also be joined by Kumar Rakesh of BNP Paribas to discuss his call on the auto sector. Welcome back. Just a few seconds before we get the pre-open rates. So in the meanwhile, let's go back to Sudarshan as well as Mitesh and understand what are their top picks for the day. Sudarshan, you go first. What's on your radar?
It's still a long side list, but there's a difference. Earlier we were getting a lot of breakouts and stocks, the mid cap and small caps that were willing to go higher. Today it's not like that. Today it's a very subdued list. But for whatever it is, Ramco Cement is a buy with a stop under 1015 despite yesterday's big move. Jubilant Foods is a buy with a stop under 685. One of the stocks that is building a base and could actually be an attractive longer-term trade is Voltas. Voltas is a buy with a stop under 1260. And finally, Vedant is a buy with a stop under 450.
Got it. All right, Mitesh, what about you?
Yeah. I have one all-buy list as well. Buy on OFSS with a stop below 9,000 or targets of 94 can be looked at. A buy on Excite for targets of 415 and a stop below 394. A buy on Adani E-Solutions with a stop at 880 for targets of 945. And IRB Infra is the final buy call. Keep a stop below 52, look for targets of 56.
Okay, all right. Gentlemen, thanks both of you for joining us. We'll sort of get back to you at 9:10 with your calls at that point. Let's just focus on what's happening in the auto sector. Well, we've Kumar Rakesh, India analyst, auto and IT at BNP Paribas now joining us to take some questions. Kumar, great to have you with us here. Good morning, appreciate it. The only talking point has been rare earth minerals and restrictions, etc., around it. And we've had, the SIAM president, the FADA president, and other analysts, etc., coming in as well. So I just wanted to get that out of the way first. Do you see that as a significant, recurring, continuing kind of problem, or you think it'll get sorted? The main issue was, of course, US-China, everybody else also getting hurt along the way. But what is your sense?
Morning, Prashant, and thank you for having me. Rare earth will start impacting the automotive industry, both two-wheelers and passenger vehicle. But we think the supply chain still has some inventory, and that should take care of production till the end of July, sometime around July. And the hope is that by that time, we would get some resolution around this in terms of negotiations which are going on. But if these negotiations do not fructify and result in the easing of the supply, then possibly by end of July, the supply will start drying out. Companies which have inventory possibly may still have some of the headroom to continue to show dispatches. However, towards the end of July, we'll start seeing some of the signs. And it will not be restricted only for EVs. Even the ICE vehicles will start seeing an impact.
Hi, Kumar. Good morning. Good to see you, Vin. Let's focus on Tata Motors. They had an analyst meet and they sounded very optimistic, right? Market shares they're going to be gaining. They're talking about improvement in terms of free cash flow. And also they were saying that, their focus really is on profitable growth. However, there are various challenges and, the business is very dynamic in nature. What did you make of those takeaways that you got from that analyst meet? And also, if you could tell us your view on the stock?
Hi, Nigel. Yeah, so the targets are quite aspirational, both on the commercial vehicle business as well as passenger vehicle business. Some of them are reassuring. We have seen Ashok Leyland expand margin quite smartly, and seeing Tata Motors also targeting similar expansion in margin in the coming years, despite the cyclicality of the business, is quite assuring. They are also targeting market share expansion in the CV business, primarily driven by small commercial vehicle. We'll have to see how much of that is possible given the intense competitive intensity that we have seen, especially getting into the small commercial vehicle business. On the passenger vehicle business, they have lost a bit of market share over the last year, and they are targeting to start expanding their market share in the coming couple of years. They are backing that with multiple model launches. But the challenge is industry is now going to see a significant model launch across major OEMs, be it Mahindra, be it Maruti. Most of the top OEMs are going to see a very expanded portfolio in the coming years. So it may not be easy to expand market share, plainly driven by model launches. The strike rate of those model launches becoming successful needs to be very high. And so while we are quite cautious in terms of what kind of market share expansion in this environment is possible, but that is what they are aspiring, coupled with the margin expansion as well. So while we are not as enthusiastic about the market share expansion, we do expect the margin to expand from where it is today. And more importantly, valuation seems to be quite attractive. On our numbers, the stock is trading at about 7% free cash flow yield, which looks very attractive to us. And hence the downside risk in this stock seems to be quite limited.
Okay, so Kumar, that's one idea, Tata Motors. Anything else? Because the thing is that with the auto space, barring Bajaj, barring M&M, and recently Eicher started doing well, it's become a sort of a complete damn squib of a sector, if I could say. Anything else? I mean, would you look at Maruti or Hyundai? I mean, the PV guys at all?
Hi, Survi. I'll completely agree with you. Actually, we are getting into a phase in which the growth for the industry in general is moderating. Most of the segments are going to see low single digit to mid single digit sort of a volume growth. And hence, we'll have to become quite selective in terms of what stock we are looking at in the automotive space, especially in the context of the valuation at which they are trading. And in that context, Mahindra obviously stands out. But some of the investors are getting concerned that the trade may get crowded out because it's becoming a consensus buy now. What we see beyond Mahindra, Ashok Leyland starts looking very attractive. All the lateral data that we have been tracking is indicating that the commercial vehicle business should start getting into an upcycle. And Ashok Leyland would be entering this upcycle with the highest margin they ever had, one of the best free cash flow conversion they have seen in the history. And as they enter into the upcycle, these numbers are only going to get better from here. And valuations are quite palatable in case of Ashok Leyland. So that's another cyclical pick that we see looking interesting for the current financial year. Looking a little longer, Maruti Suzuki also starts looking very exciting. Their export strategy continues to do really well. We think that they'll surprise positively on that front. And on the domestic front, they are going to start seeing the model launches in the next couple of years. And usually the stock has done in the environment, in the period in which they have been launching new models. And that probably will start seeing in the second half of the year.
Absolutely. You know, we have the Chola Finance management joining us a little later at 9:30. And I was just sort of reading through some of what they presented at the Morgan conference, which just finished, and they were talking about how CV sale volumes are still pretty tepid. Government spending, etc. so far this year it's not picked up materially. So, you know, it'll give you a kind of a connection across other CV makers, etc. as well. We'll see. But do you have coverage on, Kumar, on auto anchs?
Not much.
Okay, not very much by way of coverage. You know, just one more, if I can sort of squeeze in. I think you have coverage in the IT services space as well, right, Kumar?
Yes.
So if I can, go off track here from auto to IT. Just wanted your thoughts on Coforge, because we've got very strong commentary coming in once again from the Coforge management. Again, at some of these conferences, seem to be completely immune to whatever else is happening in the sector, execution, etc. Deals which are already locked in. So just wanted your thoughts there, Kumar.
Yeah, so I don't cover Coforge specifically, but the IT services space, specifically some of the mid caps, are going to see some benefit partly because of the focus of enterprises on cost takeout deals, because inflationary pressure is possibly going to increase, partly because of tariff, partly because of just the slower macroeconomic environment. And hence, we could potentially see some of the Indian IT services companies benefiting out of that. We regularly track the deal win momentum. It slowed down in the month of April and has been largely steady in the month of May. But more importantly, the BFSI space, where some of these mid-cap companies are relatively very strong, continues to be very strong despite the deal signings by BFSI companies, seems to be very strong. And that suggests that some of the companies may still continue to see relatively lesser impact of all the trade tariff and the macroeconomic concerns that we are seeing.
Okay. All right, Kumar, thanks very much. We will leave it on that note for both autos and for IT. Good conversation this morning. Thanks for joining in today. Well, that's a view coming in on the auto space with a quick take on Coforge as well. The market in the pre-open has settled with a 92-point up move on the Nifty. So looking good. And remember, if we continue to trend at these levels and if we stay there decisively, then we get that break out of the range that we have been discussing and talking about. The mid-cap index also up about 0.5%. So it's looking fairly solid, at least at this point. Let's go back to our technical experts then and get some 9-10 trading ideas. So Darshan, so what stock would you go with?
I'll go with Voltas. Buy Voltas with a stop under 1260.
Okay, Voltas will be Sudarshan's pick. And Mitesh, morning, what's your stock?
Morning, Surbi. I'll go with a buy on Excite for targets of 415.
Okay, so Excite and Voltas got those two stocks. Thank you for that, gentlemen. I'm just checking what's happening to Protean eGov. 4% up in the pre-open. That's what we are getting. Remember when the slam dunk on the stock was 20%. It was serious value destruction when it became clear that they are not being made eligible for this PAN 2.0. Today, it's a 100 crore order. I mean, it's not earth-shattering. It's not sort of groundbreaking, but it is some positive news that at least coming in. And that stock is up 4%, at least right now in the pre-open session. Let's move on. We've got a couple of interesting brokerage notes as well to take note of. We've got Sud with us. Sud, you're looking at Sona BLW?
That's correct. So Bernstein has today come out with a note and it has downgraded the stock to market perform from outperform and reduced target to 540 from 550. Remember, the stock has gained almost 38% from 52-week low that stock had hit in the month of April. Now, what does Bernstein say? It says there are some near-term risks like first, Trump-Elon Musk tensions, proposed bill phasing out EV subsidies, and ongoing US-India trade issues and rising strength of Chinese OEMs. So apart from these risks, the Bernstein says it sees risk of further earnings downgrades because company has significant US exposure and bulk of its order book are tied to EVs. 77% of Sona BLW's order book is tied to EVs and 40% of revenue US contributes to total revenue that Sona BLW has. And its largest customer, a US EV OEM, which forms 15 to 20% of total revenue, has been losing market share. Now, factoring all this, Bernstein has lowered FY 27-28 auto estimates by 4 to 5%. So today we might say down move in Sona BLW on the back of this note.
Okay, all right. So thank you very much for that. So that is Sona BLW, a bit of a downgrade coming through. The paint sector and the competition in the paint sector, of course, is top of mind. And Mangalam is here with focus on exactly that. Mangalam, morning.
Good morning. So there's a note this morning that has come in from Morgan Stanley, and they believe that there is another leg of derating likely for the paint companies because these companies are now transitioning from a period of a coordinated, disciplined, double-digit value growth to a period of uncharted levels of hyper competition and a lot of demand uncertainty. And this is what they say when it comes to this transition. One, that there is disconnected trend towards the macro environment. So, you know, the paint sales growth versus the GDP growth aren't as correlated anymore. Secondly, the sector is witnessing a fair amount of competition. And as a result of which the incumbents, instead of growing the market, are now, working towards defending their own market share or market share gain strategies itself. And as a result of which the street may not have yet understood the potential derating. And this is what they believe, that the next 3 years will see the top 5 players, X of Birla Opus, to lose about nearly 300 basis points of market share. And Asian Paints will be the one which will lead the market share loss. They will lose another 209 basis points of market share after having lost around 400 basis in the last financial year itself. So as a result of which, they have, cut their target prices on all these companies. Asian Paints, the target price has been cut from 2100 to around 1900. For Berger Paints, down from 482 to 466. And Kansai Nerolac, down from 221 to around 212.
Indeed, thanks a lot for that, Mangalam. And incidentally, Morgan Stanley, they're bullish on Grasim. They say that there are, multiple opportunities playing out for the share price in the medium term. They go on to point that the strong earnings growth that's coming in for Ultratech, which they're quite positive on. They believe there's going to be, value is going to be unlocked in the paints business, and the new age business as well is scaling up well. So that's one of the reasons why, in fact, that stock as well, one of the top gainers on the Nifty. Morgan Stanley going overweight on the stock, target price at around 3,500 rupees odd, up and about.
Absolutely. And, lots of movers this morning. So that's another one, which is Grasim. Just about a minute to go for the market open, and we'll kick things off and sort of take it from there. 90 points higher, 92 points higher on the Nifty. The sensex is up about 200 points. That's about a 0.25% gain, which is coming through. What do we have in terms of first trades? We'll get those and then sort of get going from there. I think there are, of course, individual names and stocks with news flow, not many, but there are a few. There are these brokerage upgrades and downgrades, more downgrades than upgrades today. But of course, there is, a list of stocks which perhaps we carry over from yesterday. Financials top the list there. NBFCs and sort of financials, which have done well for 2 days in a row, Friday and yesterday. So more steam, we'll find out. About the first ones coming up. What do we have? 25,161. I think we're basically back to almost yesterday's highest level. And the Nifty Bank is also starting higher, but barely so, 56,850. So it's now blinking red and green, the Nifty Bank. The Nifty is steadier with about a 0.25% gain coming through. Mid-cap index is up about a third, and I think you've got the small-cap index, which is up about a 0.25% or so as well. So that's the overall picture, the heat map, and we'll give you a quick snapshot view as always. It's all up, mostly in the green. Everything up, actually. Just 4 names, which are starting in the red. And I think we highlighted a bunch of those for specific reasons earlier with Eternal, with Karan Thorani, and of course, Mangalam just talking about Paints and Asian Paints there is one of the stocks in the red. Surabhi.
Yeah, I mean, financials not off to the best start this morning. Maybe taking a bit of a breather. Friday, Monday, we've got 2 good days on the board. So the Bank Nifty is very quiet. The one financial stock that's bucking that trend is Jana Small Finance Bank. Jana was up about 5% last I checked because they're applying for a universal bank license to the RBI. Anyway, back to the Nifty. So 50 points up. What's leading it? Grasim, because of that Morgan Stanley note that Nigel mentioned. Actually, Morgan Stanley is even optimistic on Ultratech. They're saying Ultratech, the target price has been increased to 14,000. So that's a thumbs up coming in from Morgan on both of those 2 stocks. Shriram Finance still finding some gains, 0.5% on the upside. There's BEL, which is 1% higher. There is Tata Steel, ONGC, NTPC. These are some of the early leaders. Maruti Suzuki managing 0.5%, Infosys managing 0.5%, a little bit of a green tick on Geofinance as well. And then it starts fizzling out. Wipro is managing about 3-4 rupees of an up move, and then it's getting very quiet. The Nifty is finding it difficult to, by the way, hold on to the opening pop. Now we're talking just about 26, 27 points on the upside. So there is some pressure building in. Okay, so what is down? HDFC Life on the lower side. Asian Paints, the stock that Mangalam just spoke of, 1% lower. And then it's the financials. HDFC Bank, ICICI Bank, they're all pulling things lower. And the consumer stocks are also not in the best form this morning. HUL, Tata Consumer, Nestle, all of them on the red side of the screen. So it's getting really quiet. The Bank Nifty is now showing red. And the Nifty is tracking a gain of just about 20 points. So not able to sustain convincingly above this trading high that we've been speaking of.
Well, a couple of stocks that are in focus. Jindal Saw, the problem for them in the past has been no visibility in terms of growth. Now they've laid out a capex, so the street likes it. So it explains why the stock is up 3.5%. Keep in mind, yesterday it ran up close to around 5% ahead of the announcement. But today it's building on, telling you that this is a positive. So that stock is up and about in today's trading session. ITD Cementation, stock of the morning up 900 points. Stock is higher on the 900 crore order win that they have got for a captive jetty in Odisha. So that's up close to around 8%. Big move is what we are seeing out there. IFB Industries, one of the stocks that we don't talk about very, very often, but it's been a big underperformer. They had an analyst con call, and in fact, they are talking about guiding for cost reduction benefits from the second quarter. However, Equirus, though they are long on the stock, they say given their long track record of disappointment, they're going to wait by for delivery. For the time being, though, the stock is up close to around 4.5% or thereabouts. A good move is what we are seeing out there. Premium Energies, the large trade got done, the stock is up. Seems to be a trend now. Once the large trade gets out of the way, the stock, in fact, recovers. So though it was at a bit of a discount, that stock is up and about. And Protein E-Cover, the other stock that we had highlighted earlier today, that as well, doing very, very well in today's trading session. Big move is what we're seeing on that name as well. The headline index, though, as you all mentioned, more or less flattish, flattening out as we speak. The Nifty Bank, a little bit of an underperformer.
Yeah, absolutely. Lots of names are coming up. We got still, by the way, got about 1,800 stocks which are higher and about 450 stocks which are lower. So that is the, the overall market advance decline ratio. Reliance Power and Reliance Infra are back to slightly more winning ways, 2%, 3% each on those names. And I think ITD, Jindal Saw, etc. we've mentioned. Yesterday, the railway stocks continue to move. RailTel is up 2.5% and is coming up as the third largest volume-led gainer. Grasim, of course, I think Nigel mentioned 3% with that call as well. Kernex is another railway name, though, actually, 3.5% higher here. Cosmo First, basically took a 5-day break after moving up from 650 rupees to about 1150. 5-6 days break and then back 5% higher. It's limit up on Cosmo First 1,217 on about 130 odd thousand shares. There is this defense name, used to be SME, but now on the main board, decent volumes. That's why I'm mentioning it. 5% on Nibe, 1765 is where that is coming up at. But, you can find more names down the list, but volumes kind of start to drop off very, very, very sharply, very, very fast. Capri, of course, there's I think block 3.5% lower. 175 was up sharply yesterday. And Shakti Pumps and a few others. JM Financial is down about 2%. Motilal Oswal is down about 1%. Sona Comstar is down 1. RBL is down 1. 5-Star is down about 2. Chola Finance is down about 1. And so it goes. So the question, is basically that, right? I mean, beyond 2 days, 3 days, will the big move in financials start to fade out a little bit? It looks like, at least the first indication is that it is very sharp gains on some of these names over the last 2 days. Surabhi.
On Nibe, Prashant, the thing with defense is that you'll keep getting this trickle of positive news flow in terms of orders, more procurement. And that's what's keeping this one higher, because yesterday they got the approval from DRDO on the bridging systems that they do, basically mobile bridging systems. And speaking of order wins, keep an eye out on Bharat Dynamics and BEL as well. On a quiet morning like this, there's some green flashing on these defense stocks because of all the buzz that is doing the rounds, that there could be 30,000 crores worth of additional procurement for the next range of surface-to-air missiles, which is keeping some green on these stocks as well. So defense news flow continues to be positive.
No, absolutely. And I think, this trickle of news flow around defense perhaps will continue. BEL is another one which is up about 1.33%. More on this as we go along. Priti Gupta is with us, CEO and co-head at Kotak Institutional Equities. Pretty good to have you with us here. Thank you very much. I mean, if there is one space with significant tailwind, in terms of news flow tailwind, it's defense. Right? You had that recent conference, the Shangri-La Security Conference, which happened in Singapore, finished end of last month. And all the top guys were there, and, the US Defense Secretary urging Asian countries to up their defense spending to about 5% of GDP. The average here in Asia is about 2% of GDP. So, everybody wants to spend more, be more self-reliant, etc., etc. The question, though, for investors is, and you'll keep getting on the tape all this news flow, which indicates more spending, etc. But you've got to weigh. You're buying stocks, right? You're not buying a story, and that's what one has to be careful about. What is your own perspective on this from an institutional angle? When you talk to clients, etc., large clients, is there interest in this space? To what degree, and what do they tell you?
Good morning, Prashant. I think, firstly, you're right that there is tremendous amount of tailwind for the defense sector as a whole. Obviously, and this is not just in India, this is happening across the board. Even Germany has announced $1 trillion plus worth of spending. Japan, Germany, a lot of Asian countries, and so on. And in case of India in particular, our defense spending has been somewhat below par, below what's required. And the recent conflict with Pakistan has perhaps woken up the establishment to the need for much greater defense spending. And this will be a multi-year theme. But as you rightly said, investors, especially the institutional investors, at Kotak, when we speak to them, they are watching the space, but they are not, frankly, showing too much interest at these valuations. What's happened is these stocks have run up very sharply since Operation Sindoor on expectations of greater defense spending. We believe this has been driven more by retail and high net worth investors buying these stocks rather than institutions. A lot of institutions are staying away mainly because of, one, the valuations, of course, but also there are a lot of significant investments which have to be made by these companies across. And I'm not talking of just CapEx in terms of beefing up their capacity, but improving their technology, investing in R&D, in people, in doing JVs with global technology counterparts, in the ability to scale up, in qualifying for many of the government RFPs for the working capital cycle for these defense companies tends to be quite long. Many of them don't have the required balance sheet. So there are some good businesses for sure, but as you rightly said, we are buying stocks. And at the moment, most institutional investors are sort of staying away because of the high valuations and the dramatic surge. They're eyeing the space. So as and when these stocks correct, you could see some disappointments in execution. Order inflows are there, but execution sort of falters. So that's when I think most of these institutional investors are looking to get back into these stocks.
Okay. Got that point, Pratik. Great to be speaking with you this morning. Thanks so much for being with us. I think the issue with the market also is the market is hungry for growth ideas, right? And they don't come by that easily anymore. And at least in defense, there's some news flow, at least on order book. And that's what gets people excited. But when it comes to, looking out for the next growth winners, do you see pockets? Do you see where maybe there's a turnaround in the works? Would it only be financials where at least now, like SBI told us, they expect to grow at least 13%. That's a huge bank. So where should one go chasing growth in this market?
So, Surbhi, that's a great point. Firstly, and as far as India is concerned, we think the macro environment obviously has been fantastic, but the problem has been earnings growth at the corporate level. On the macro front, obviously, the fiscal account, current account deficit, inflation, forex reserves, the government balance sheet, banks' balance sheets, corporate balance sheets, household balance sheets, all of that is in fantastic shape. The problem for the last 1 or 2 quarters has been that it's not translating into good corporate earnings growth. At Kotak, for example, for the Nifty, we are projecting only about a 12% earnings growth in FY26 and about a 14 to 15% earnings growth for FY27, which is better than what we saw, the low single-digit growth we saw in FY25. But still, frankly, not exciting given the valuations where we are at almost 22 times 1 year forward. Now, having said that, I think one should watch out for policy action which could change this growth dynamic, given the strong macro backdrop we're in. For example, you already saw the very aggressive action from the RBI last week. Now, take a scenario where you also see perhaps closer to the Bihar elections, maybe petrol and diesel prices at the pump come off, especially given what's happening with global crude oil prices. So that could be another big positive. The GST rates could be rejigged, resulting in an effective lower GST rate, especially for the 12% and 18% categories. So you could see some benefit over there. Again, some money being put back into the hands of the common man. You could see the government capex cycle, which has been sort of lukewarm, execution issues as well. That could start picking up after the monsoons. And talking of the monsoons, while we're going through a bit of a lull period, but the forecasts are you'll have a decent monsoon, so you should see the crop output also picking up. So all of these factors coming together by the second half of this year should result in better earnings growth, we believe, and we may see, while in the short term for the June quarter and September quarter, we're actually worried about earnings downgrade risks. So that's a short-term concern. But as we go along into next year, we think you might actually start seeing earnings upgrades coming through as well. But you'll go down, then you'll go up. So you'll probably end up somewhere in the same, perhaps, hopefully better. But going back to your point on where we see pockets of growth, one is obviously financials, banks, insurance, NBFCs. We still like those stocks, especially given the valuations where they are. I would say some of the other pockets we like are, for example, telecom, hotels, the transportation sector, which is airlines, ports, the e-commerce logistics companies. Again, as the economy is recovering and again, keeping in mind the valuations where they are, we think these sectors are some which we like right now.
All right. Hi, Pratik. Good morning. Good to see you in. Pratik, you're talking about putting a higher amount of money in the common man's hands. Common man is also putting it into the mutual funds, and that's absorbing a lot of the selling that we're seeing. What are you making of these large trades? The pace has accelerated. It's nowhere close to the euphoria that we saw in 2024, where you had much higher blocks. But actually, May was a month where, the last 1 month or so, we've seen rather high promoter selling, which has got absorbed by the mutual fund industry because they were sitting on ample liquidity. Is it getting to that stage where it makes you a little bit uncomfortable?
Not yet, Nigel. I think the amount we saw in May was, if I remember correctly, 60,000 crores, which is a large number, no doubt. But again, in the context of our $4 or $5 trillion market cap for the industry, and more importantly, the amount of cash that's sitting on the sidelines, both with the domestic mutual funds, the insurance funds, and also you have foreigners who are generally neutral to underweight on India. I think there's a lot of cash sitting on the sidelines. So that's why a lot of these block deals, IPOs, QIPs are getting absorbed quite easily. So I think we're still some time away before we start getting worried. Obviously, there's a large pipeline of IPOs and blocks still out there. As far as IPOs are concerned, Kotak itself is in the lead for many, many IPOs, but they're probably the large ones are more towards the latter half of the year. Blocks, again, that usually tends to be in between the earnings season when companies go into silent period. So another 1 or 2 weeks, 2 weeks or so, you'll have a lot of blocks happening. Then things will cool off as we get into the earnings season. But to answer your broader point, we think there's a plenty of cash in the domestic mutual funds. A lot of them are still getting net inflows. They're still positive. They were somewhat, underweight or sitting on relatively high cash levels. So that cash is now getting utilized. And the foreigners, as I said, that I think could be a big story towards the end of this year, early next year, calendar year, wherein the weaker dollar could result in more EM flows. And that in turn leads to India also getting its fair share. In fact, that's the one big trend one should watch for as we get towards the end of FY26.
Yeah. But we're in a situation where blocks are getting done. Maybe actually some of them at discount as well, but some of them not at discount. And look at Premier Energy. Stock's up 4% now, right? I mean, 2.5 crore share block got done, and it's moved up to about 1,107 or so at this point. Coforge is another one. Coforge is up 4%. You know, the entire IT services pack on one side and Coforge on the other. So exceptional commentary once again coming through from the Coforge management. IT services, and I don't know if you have any thoughts on Coforge specifically, Prateek?
So IT services, we've been somewhat cautious in general last few months. Our view has been that the US IT spending outlook is it's weak, but it's not deteriorating. The problem has been the valuations with these IT companies. Growth is for the large caps, it's in single digits. For the mid caps, it's in 15 to 20 odd percent, depending on which mid cap you're talking about. I won't be able to make any stock specific comments, but in general, the growth environment is stable. But the problem is valuations with risks to the downside, especially if the dollar weakens or the US enters a sharper slowdown than expected, or maybe even a recession. The ERD companies are the ones we are actually extremely negative on. They are the most vulnerable to a slowdown in discretionary spending. So the non-ERD companies we're okay with, but the ERD companies in general, we are quite negative. So, but in general, you'd stay away from businesses, companies which are more globally exposed. The big theme for us is India is still in a relatively sweet spot given our strong macro environment and okayish sort of corporate earnings growth. Globally, it's the US valuations, the US markets, they're looking expensive. All the institutional investors we speak to, they're extremely worried about a sharper slowdown, whether it's due to tariffs or due to the bond markets having a bit of a fit. Either way, but anything exposed to global demand, we would be a bit cautious on.
Okay, take that point. So have to tread with caution. And that's exactly what the market's doing, Prateek. By the way, the market slipped into negative after opening 90 points higher. So taking it easy, one step at a time. I think that's the investor mindset as well. Thank you very much for joining in. Let's pull up the Nifty. Yeah, there we go. So we could not hold on to that opening up move of about 70, 80 points. Let's see, very early in the day, figure out how the trends go. Even the mid-cap index is very quiet, and the Bank Nifty is down 0.3%. So some of the excitement post the RBI seems to be now just taking a bit of a breather. Speaking of the RBI, let's get that conversation going. So what will this RBI bazooka, 50 basis points repo rate cut, 100 basis points CRR cut, what does it really mean for companies, for NBFCs, for banks, and for customers on ground? Well, we have with us Mr. Arun Selvandi, President and Chief Financial Officer at Cholamandalam Investment and Finance, joining in. Mr. Selvan, great to have you with us. Good morning, sir. So you tell us, I mean, we were all going in with the expectations of a simple policy, 25 bips rate cut, but we've got a bazooka. Now, what does this mean for a company like yourself, sir? Because you've already been speaking about growing 20 to 25% this year. So will you bump up that estimate? And what happens to NIMs? Could your NIMs start looking a lot better by the time we exit the year with the liquidity gush?
So surely the NIMs will be better, and we should see this flowing through to the ROTA, I think, over the next 2 to 3 quarters. We may not see much of it in the first quarter, but it will show up in the second and third quarter. As I have told you earlier, a lot depends for us also on how the banks pass on this rate cut by way of an MCLR cut, because a large part of our borrowings still are from banks, and many of them are linked to MCLR. To answer your first question, I don't think the rate reduction alone will bump up the disbursement in entirety, because that would depend on the demand in the market and also how the underwriting goes through. So we will be cautious about scaling up in immediately just because there's a rate cut, and also for our floating rate book, which is our LAP, HL, etc., we may have to pass it down. So we may have a slight that may not really result in any large scale upswing in the disbursement. We will be cautious. We still hold on to the 20 to 25% range of AUM growth quarter over quarter. Yes.
You know, how much of your book is fixed? How much is floating? And by the way, I think there was a flash. We'll just try and get it back as well. I think ICICI Bank has cut its deposit rates by 25 bips. And that's the other thing that's happening, that lenders are repricing their deposits also very quickly. Far more, agility on that front than what we are used to seeing in the past. But for you, how much of the book is fixed and floating?
So in our the vehicle finance and SBPL book is fixed. The loan against property, HL, and the SME books are on floating. So almost around 60% would be 62% would be fixed, and the balance would be floating.
Okay.
Net,
Mr. Selvan, after everything is said and done, and pass-through happens, etc., and you have to pass through, can you give us a broad sense of what will be the broad impact on net interest margins a couple of quarters down the line?
I would safely say around 10 to 15 basis points we should certainly be able to improve, if not better. I am wanting to be cautious about giving any guidance because it comes back to me quoting.
No, we will not.
They keep asking why you are not.
No. That's not the intention. At least we won't do that. So you're saying from a finish line of FY25. Given what has happened over the next couple of quarters, once all this feeds through the system, you should be able to improve margins by 10 to 15 basis points.
Yes, it can be better, but I'm just keeping it cautious.
So closer to 8% rather than 7.5% on a full year basis, FY26 margins, right?
It will, 8 margins, yes, it will be. Sorry,
closer to 8%. Okay, yeah. Got that point, sir.
All right. Hi, Mr. Selvan. Good to hear your thoughts, sir. A couple of questions then. Consumer and small enterprise business. I think as a percentage of your business, 3 years ago, it was only 1%. Now it's moved to around 8%. How do you see this business scaling up? Point number one. And point number two, gold is providing another opportunity. We heard from the RBI governor as well with regard to his take on gold. And you all have forayed into that segment. How large can this business become for you?
The consumer and small enterprise business will continue to be at the sub 10% of our total AUM. This is what we have stated. We will hold it there. You may see some, drop in the initial quarters because we are consciously exiting the fintech partnership line in this, which used to be around 25% of this book, and we are building our own, app which will scale up. So this scaling up to come to the same levels as what we have been clocking on the fintech business would take another 2 to 3 quarters, post which it will start clocking at similar pace what it was going through in FY25. So initial 1 or 2 quarters you'll see some slowdown, then post that it will come back to its normalcy. With regard to the gold, yes, we will be scaling up. We just entered it. It is in a very, very initial stage. I think it's too early, but I would say in the next 2 to 3 years it should be in the range of around 3% of the overall AUM, because by then AUM would also have grown for us in its entirety.
Okay, 3%. In the next, so that would be what? Ballpark approximately closer to around 1,000 crores?
More than that, around, if I am, I don't know, you will hold me to the area.
No.
Overall book. So
it's an aspiration, sir. Aspiration.
Yeah, let me, instead of the percentages, let's say it will be around 2,000 crores of book. I'll keep it that.
Okay, that's the aspiration. Mr. Selvan, got that. This is significant relaxation, right? I mean, in terms of, especially for gold lenders. So, what the RBI has done, and we've spoken to a few pure gold lenders as well. So, we'll see how this goes in terms of competitive intensity, etc. as well. They really opened the taps in that sense. Now, let's just come to vehicle finance. I was reading a note, and I think you guys had presented at one of the conferences which happened recently. You were citing weaker volume growth so far this year in FY26, low government spending, etc. Could you talk to us a little bit about that, or how are collections looking? Are they kind of lackluster? When do they pick up? What's the forecast?
See, vehicle finance, especially for Chola, depends a lot on the rural growth. The monsoon, which in turn depends on monsoon. Monsoon had started early, but there seems to be a small bit of a lull, but we need to see the impact of it. The success of Kharif would be the key driver to make sure that our vehicle finance, growth will be at a better than what it was in FY25. That is on that cautious note we spoke about in the conference you're referring to. But I think we need to wait and watch. Right now, there are both sides of the monsoon. Monsoon initially has been so far has been at a slight deficit to its normal level. So we are being cautious. But otherwise, if that comes in its full form, what it was originally predicted, we should be clocking what we had spoken about.
So, sir, if we go back to your guidance of 20 to 25% growth, within that, what is the kind of growth that you're expecting from the vehicle finance business? Because that's bread and butter. And how much will the other segments perhaps be able to contribute?
See, the vehicle finance should be in the range of around 15 to 18%. This is what we have guided earlier also. We keep it at that same level. So, but we are just giving this word of caution that monsoon's success is what will be the key driver for vehicle finance growth. That's the only point.
18 to 20%, and non-vehicle, I think LAP and home loan will be approximately 30%, right? That's how you come to that number.
Yeah, LAP will be around 30%. Home loan will be also in the 20 to 25%. The new businesses will start clocking a little bit more. Yeah.
Okay. All right. Final question from my end before we let you go, sir. Last year, I think the credit cost was approximately 1.45%. You can correct me on that number. This year, will it be lower? If yes, how much lower?
It should be lower. We are estimating, again, cautiously around 10 bips lower than what it was last year, full year, FY25 versus FY26. But we should, again, this also has a lot more dependence on the monsoon, because the success of monsoon would spur, not only the demand for vehicles, but demand for all other white goods and FMCGs, which in turn pushes traction of the vehicle users. Then that would give, impetus for them to, maintain their payments on schedule.
So around 1.35%. 1.3
Yeah, 1.3 to 1.4%, 1.35%. I would keep it there. Yeah.
Mr. Selvan, I mean, to end with, I want to go back to gold loans, because that's always a very exciting part of the market, right? And since you've decided to enter the segment, I mean, obviously you've done a lot of groundwork, homework and study. On a steady state basis, given the competition in the market, and you have large incumbents like Muthoot or Manappuram, a lot of banks are getting into this business as well in the south. So what is your assessment, steady state basis, 1, 2, 3 years down the line when it's built? What is the potential that you see in the gold loan business? How much growth can it contribute? Can it become a very big driver for Chola? And what's the steady state of growth from a gold lending point of view?
It's little too early days, and the only good thing I can say is that like new guidelines have come, before we even started, so we can start on a clean slate, and it is much better than many of the other competitors who may have certain old, loans, etc., which could fall under the guidelines. But having said that, to answer your question, I would say that we should be able to clock it at again the same levels of around 20-25% on a steady state basis. A CAGR over after 2 to 3 years. Initial years, it will look very high, but it will be on a very small base, so it is not really meaningful.
Yeah, but 20-25% growth, steady state, once the base is built on gold loans. Got that. Thank you so much, sir.
Thank you.
Thanks very much for joining us, Mrs. Selvan. Appreciate it very much here on CNBC-TV18. Markets, by the way, have given up pretty much everything. I mean, we're absolutely flat, a 4-point change, 25,100, unchanged as compared to yesterday. But broader markets are doing very well with about 2:1 in favor of advances to a decline ratio. I think, Nigel, we have the Jana Small Finance Bank management with us.
All right. Well, let's focus on Jana Small Finance Bank. Well, the stock is surging in trade because they've applied for the universal banking license and they're seeking voluntary transition from a small finance bank to a universal bank. To discuss this and more, as well as what's the outlook, we're joined by Mr. Ajay Kanwal, the Managing Director and CEO at Jana Small Finance Bank. Hi, Mr. Kanwal. Congratulations first, sir. The street likes what you have said. Give us a couple of details first. Give us the timeline that you expect this to finally go through.
So first, very good morning to you and all the viewers. Timeline, listen, the submission has gone through yesterday. I guess couple of months is what it should take. There is no definite timeline we are expecting or waiting for. But I think more importantly is it took us 7 years to get to a point where, we are meeting all the norms set forth by the Reserve Bank of India from applying for a transition to universal bank. So for us, the more important thing is able to meet the hurdle and then put up a credible, strong proposal in forward and hoping for their positive consideration.
Okay, all right. Now, since you're going to be moving into a universal bank from a small finance bank, could you highlight the key positives, for the bank going ahead? It'll help you grow, it'll help you in cost of borrowing and various other ratios as well. So if you could state the top three, will help us.
So first is, the velocity of deposit gathering should improve. Certainly should help CASA. I think the pricing of deposit should get better. So that is very important for us also. Third, we are very capable of doing supply chain financing, sales invoice discounting, purchase invoice discounting. But many of the mid-sized, large MSMEs, small corporates, they are not sure if small finance banks can deliver on that. So I do think our upper end of customers in mid to large MSMEs, small corporates, where we can serve them, will also find it comfortable to deal with us. So if you think about it in one simple way, it certainly helps cost of deposit, speed of deposit, quality of borrowers who are probably not available to us today in the right manner. I think those would be the three key advantages.
Yeah, no, absolutely. And we'll see when that comes through. Mr. Kamal, good morning. Good to have you with us here. Just this, the here and now, which is the big push which the RBI has given with these cuts, repo and CRR, etc. as well. How does that change the trajectory for you on? Let's just start with margins first. Once all this feeds through the system, banks lower their cost, and how does that work?
So I think first big picture in my head is it's growth oriented. It's very positive. So it's economy should do better. I think the regulator has been ahead of the curve, so which is brilliant. And that means very positive news for certainly credit growth and certainly the way of the credit quality also. So I think two things we should take into account, which is credit growth will be better than what it would have been without the cut. And credit quality will also be better because clearly we'll see much more economic push. From a NIM perspective, yes, we will start seeing deposit rates go down. We haven't really got there as yet. But in the next day or so, we will be cutting our deposit rates. And simultaneously, we'll be seeing a drop in our lending rate. So yes, it will be more in favor of the borrowers and the savers will get slightly less money.
So, Ms. Kaval, hi. Yeah, morning. On NIMs, I think you ended the year at around 7.6% net interest margins, FY25. Now, as all this plays through the rate cuts, but the fact that, there's ample liquidity as well, what will it mean? For this year, what's the outlook on NIMs?
So I think our NIMs have been showing a compression from 8% last year to 7.7 this year, mainly because our balance sheet is turning secured. That's been our regular push from the day we started the bank. So we are 70% secured. Every year we move the needle. So we move from 60 to 70 and our NIMs did come down. So we expect that compression of NIM of turning secured anyway to take our NIMs down by about 10 bips. I would imagine that depending on what we do with deposit rates and the loan rates, which we'll decide in this week, we probably add a NIM compression on the 10 bips at best.
Another 10 bips of NIM compression. That's because of your stated strategy of, going for more secure deposits. But on that, Mr. Kanwal, I mean, it's quite curious because a lot of lenders have been pushing on the unsecured side and probably very happy now that, the norms are no longer as onerous as they were in between. We heard the RBI governor also say that perhaps the worst of the unsecured stress is over. We heard that in the policy on Friday. So why is it that you don't want to, or you want to sort of, come down on this segment a little bit? And I go back to that growth question as you wait for your license application to pass through for turning into a universal bank. I mean, what is your strategy on growth? Where will it come from? And also the timelines that you're working with, where you're expecting to hear from the RBI.
So listen, when we began the bank in 2017, we had 100% microfinance business. So everybody is different in what their composition is. So our parentage was 100% unsecured. Now, when you start a bank, you're taking deposits and your first real obligation is to make sure depositors' money is returned back on time and in full. For that, you need to have, at least in my mind, and what our board and strategy agreement was, that we should make the bank 80% secured, which means home loans, LAP, MSME, supply chain, gold loans, two-wheeler loans, something which is asset-driven, business-driven, and has collateral backing it. And that was a primary purpose, that we should have 80-20 secured, unsecured mix. So we are moving in that direction, and that hasn't changed. And I must say, over 7 years, it does seem like the right answer. I'm not saying unsecured business is not good. It's certainly a great business, but we have enough of it. We have less of secured, so we're growing that. Also, I must say in our unsecured business, which is largely microfinance, we have gone ahead and put it under the guarantee programs also. Because having seen the stress of last year, we thought to take away any amount of event risk, it's best that we even get the unsecured business under the guarantee program. So maybe slightly more conservative in our thinking. Okay. But our bias is that we rather have a more predictable, very consistent performing bank. And if you have to do less unsecured to get there, then that will be our strategy.
Just a quick question on the MFI book itself. You had sounded a little bit cautious earlier, and you were one of the first to point that out with regard to stress in the system. Do you think the worst of the MFI stress now is behind and things, are on the mend and looking up from here on?
So I would say that two things. One is, I think the MFI new normal is not what it would be if you took what existed in terms of collection rates, etc., prior to March of 2024. So I think we'll all have to think of what the new normal would be in an MFI business. It is not as easy as it used to be, for sure. Second, I wouldn't think that the worst is over. I would think that worst has reduced, but it's still hard work. I must tell you that we've also seen that till December last year, we thought it was over. Then we had a Karnataka ordinance, which was, of course, meant for a good purpose. But obviously, a lot of the people on the margin want to make misuse of it. We saw a bit of more slippage. We are just steadying now. But yes, I would be very watchful, clearly in this segment. And there are enough and more reasons why we should just watch it for some time. I wouldn't say the worst is over, but I would say, yes, the peak of the worst is over. But we are not back to MFI after 1 year of stress is back. I wouldn't say that.
Peak of bad news is over. That works for now. Thank you very much, Mr. Kanwal. Good luck with that banking license, and we'll speak more as we go along. Appreciate your time here on CNBC-TV18. We'll take a break. We're back. As promised, we've got a real estate discussion coming up with Knight Frank and Tata Realty. So will the RBI move spur real estate demand? Additionally, that's the question coming up. Okay, welcome back. Markets up 25 points. It's a more settled kind of screen as compared to yesterday, and most definitely as compared to Friday when things were flying around. Well, we've spoken so much about banks, right? But real estate is another area where markets have bid up stock prices on the back of expectation that this will at the margin maybe, help demand a little bit more. Shishir Baijal is Chairman and Managing Director at Knight Frank India. Shishir, good morning. Great to have you with us here on the program. Thanks very much. Prashant, this side. So how does one think about this? Will this, this will help people with EMIs, etc. But a rate cut, will it really spur demand, end-use demand, in your opinion, Shishir?
I think it would. I think the banks front-loading the rate cut to a 50 basis point cut is a substantial move. It's far higher than the 25 basis point cut that the market had anticipated. And I think this front-loading and the transmission of this to EMIs will most definitely help the affordability, and it will definitely boost the residential segment. Primarily, the one segment that will really help will be the affordable, or if I would say close to the 50 lakhs to 1 crore segment. If you look at the residential change that's happened since the pandemic, during the pandemic time, this segment used to have close to 45% share of the market. And that time, the market used to have close to 160,000 units a year. I'm talking about 2020. The market's gone up to 350,000 units a year, while this segment was languishing and the share came down to 25%. So our feeling is that these rate cuts would really have a meaningful impact in this segment. And I do hope with the transmission that's going, the affordability picks up and the demand for housing picks up in this segment, which perhaps has the largest segment of demand in our country.
Shishir, great to have you on. Thanks for joining in. Rate cut, liquidity and pricing, we've rarely seen a connection, right? Especially in super hot markets like Mumbai, pricing is a different beast altogether. But, take us through some of those recent trends as well, because there's been some evidence, or at least some chatter, about, a lot of inventory building up. Some concern on, if you leave aside the marquee transactions, say in Mumbai, which is, sort of the big bulge bracket transactions that have happened, whether registrations are showing some signs of a slowdown. Could this just be an interim patch, or is there some concern building up? Particularly in some of the top residential markets, NCR or Mumbai?
I think you'll have to have a look at it because by looking at it just on unsold inventory or the inventory building up may not be perhaps the full answer. If you look at the velocity of sales, if you look at the age of inventory, I think they are all fairly healthy. In fact, perhaps at the healthiest level for a long, long time that we've analyzed. So in most of the cases, the length of unsold inventory is less than 8 quarters at the max, which is fairly healthy. The issue really is in the lower segments. I think whilst there has been a plateauing of the numbers in the higher segments, but there is still substantial traction there, as we have seen even in the Mumbai segment. The above 5 crore is still showing a robust growth. The little plateauing of the growth is really in the medium and in the less than 50 lakhs.
Yeah, because those registrations, I'm talking Mumbai particularly, that really made big headlines, right? Because registrations had fallen 4% in May, which is why the question, and this is a sub 5 crore market that we're talking about. Right. Is this just a small blip, or would you read anything more into it?
We'll have to look into this. It's very, very early days for a month's data to come in. But if you look at it the same month, the total revenue collected by the exchequer was higher, and that's fundamentally based on the higher segments. So our ardent wish really is on this front loading of the 50 basis points and the transmission that many of the banks have given for the EMIs, that this will boost the demand of the segments under 50 lakhs and 1 crore. And I think that's where the major potential lies in demand.
Yeah,
as well as for developers to come into it and for supply to increase within this segment.
Yeah, we've had listed developers, we speak to regularly on quarterly earnings. Some of them have moved away from that segment to more premium because that's where the demand has been booming. but maybe this will revitalize that segment once again. Sanjay Dutt is also with us of Tata Realty and MD and CEO of Tata Realty and Infrastructure. Sanjay, good morning. Great to have you with us here. Prashant this side. Just give us a quick sense of your kind of lay of land as far as Tata Realty goes. How much is commercial? How much is residential at Tata Realty?
So we have over 10 million square feet of commercial, which is built and leased, and about 20 million is under design and development. And roughly 13 million square feet under residential across major markets is under design and development again. So I would say nearly 50-50 portfolio. At one time, we were predominantly residential, but now it's a very balanced portfolio.
Okay. And on the residential side, how does, which segment are you mostly present in? As Shishir was talking about, I mean, focus is under 50 lakhs. That's where it makes most impact in that sense. From Tata Realty's perspective, how does this play out?
So last 5 or 6 years, our strategy has been to focus on key metros, the top 5 or 6 cities. And as a result of that, because it's a very urban focused strategy, we are in the more premier and mid segment and select few luxury segment. There was a time when we were in affordable, but over the last 5 or 6 years, we have changed a bit of strategy and focused more on urban growth.
Sure. Mr. Dutt, that's why the question, hi, good morning, Surabhi here, and that's why the question, and we started asking Shishir about exactly this.
Yeah.
How closely linked are interest rate cuts to real estate demand in this, a mid-premium to slightly more premium housing segment? Because for affordable, one can understand every 1,000 rupees saved in a home loan EMI matters. But when you're talking about mid to higher end premium housing, then isn't it more closely linked to, say, the wealth effect from the stock market or job security, the bonuses that you're getting? Do interest rates really matter when it comes to the affluent housing segment? Mr. Dutt?
So, one take is, of course, from the consumer point of view, lower EMIs, it does matter because you can actually upgrade yourself from a very compact 3-bedroom to a normal 3-bedroom or a slightly better amenity and quality development. At all segments, it does matter. And I think if you look at it from the developer's angles point of view, the cost of capital, which has been an issue, the cost of construction, which has been rising, and the land cost, which has gone up, any relief by the government and interest rate does make a difference. And therefore, it makes the whole sector overall healthier.
Premium segments will be, as you said, I think the impact, point taken there, but I think it's also interest rates, lower interest rates, higher stock prices, higher
feel-good
gains.
Factor, yeah.
Not feel good, real factor.
So the higher the Nifty goes, the higher the demand for premium real estate, right?
Bigger capital gains and that's been, of course, the prime driver, stock market gains, at least in big cities like Mumbai, etc. Thank you very much, Shishir and Sanjay, for joining us. Short conversation, but I think useful to put the context straight as far as the RBI cut goes. We'll just quickly run through what markets are doing at this point. And we've got, 40-point gain on the Nifty, 25,140. Mitesh is back with us with a quick check on what things are looking like. Mitesh, I think your view was you get a big open, wait for a 30-40-point dip and then sort of get in. I think that is materialized. Is this the dip to buy into?
I think, I would be very happy to buy into the Nifty right now. I'll take a stop or 25-30 points below today's intraday low. Also, the stocks that I have buy calls, Apollo Hospital is one. It's a buy with the stop just below levels of 69.20 for targets of 7,100. And Biocon is the other one. Biocon is a buy. Keep a stop below levels of 339 for targets of 350.
Okay, those are individual trades as well, which Mitesh is putting out right now. We'll take a quick commercial break here. We're going to come back and we'll focus on a bunch of stocks. Grasim, for example, is in focus, but we'll also look at commodities with Manisha. Stay tuned. Coming up.
Flip-flopping between red and green, that's the shape of the market. But the good thing is that there is buying at lower levels. The Nifty is back now, up to a 50-point gain. That's equities for you. Let's figure out what's the latest in commodities. We have Manisha with us for all the headlines. Manisha, which one are you tracking today?
Well, metals, and within this, I want to first talk about silver because this doesn't, get off from headlines there. We've seen further gains come in the overnight markets onto this one. 2% of gains in silver in the overnight markets, and we are 8.5% up in the last week. And with that, it's mirroring on what gold has done till now in this year. 27% up for 2025 till time. Well, there is strong investor demand that we have noticed, not just in the Asian markets, but in the Western world as well, especially US and Canada, where the silver coins really seem to be doing quite well. Add to that the fact that there are supply shortages in the near term. And in any case, 2025 is a fifth year of deficit yet again for silver. That has been supportive. The markets also are looking at record industrial demand as well from solar, photovoltaic and electricity as a segment. And that has been supportive for silver as well. But the other metal that also seems to be doing quite well in the very near term has been copper. 1.5% of gains in the overnight market. We have seen 6% of gains for copper in the last 1 month. And for this year, it's up by nearly 22%. There's renewed optimism between US and China in sense of trade agreements. That has been supportive for all metals across, more so for copper. And then it also has been about US tariff that perhaps could be coming in for copper. Remember, US has been talking about it, has also been investigating, and that premium has worked in sense of copper. You are also looking at supply concerns coming in from South Africa and some countries within Asia and South America as well, which has been supportive. Also, LME inventories have continued to decline, and there is a backwardation into the markets as well because the cash copper is trading at a premium of around $75 a ton to the 3-month copper. So the markets also are looking at stronger data, stronger demand for copper in the near term, which continues to be supportive for the prices. The last plate should show you on what we've done in this year until now for many of these metals. So the best of the gains really for the space comes in from platinum, 37% of gains onto this one. Much of these gains clearly have come in the last fortnight or so. Gold and silver, with the kind of catch-up that silver has done in the recent few days, gold and silver both are up by 27% now for 2025. 22.5% of gains come in for copper. Palladium is another metal that should come in on your screens because we're trading in the positive on that was as well, and a double-digit 21% of gains. And then everything else is trading in the negative for this year. Aluminum, zinc, 3 to 11% of a decline. That's exactly how iron ore, tin, nickel also seem to be trading in right now. So negative for many of these metals, but it is about PGMs and copper, palladium, platinum, which are trading in the positive for this year.
Thanks a lot for that, Manisha. Well, let's focus on one of the top gainers from the Nifty itself, Grasim. That's post the Morgan Stanley note that's coming on the stock. They've gone ahead and upgraded the stock from equal weight to overweight. The target price as well, they've raised it from little sub 3,000 rupees to around 3,500 rupees. Now, they say that Grasim has multiple opportunities playing out that could lift the share price in the medium term. So let's highlight the 4 points. First up, the paints business, they say, has fared much better than expected earlier. So they've gone ahead, they've raised the paints business valuation across scenarios. Now they estimate close to 360 rupees per share in the SOTP, or the sum of all parts of Grasim share price. Earlier, they were giving it a value of around 150 rupees per share. Next up, Ultratech remains the largest value driver for Grasim, and Grasim is likely to benefit from the multi-year earnings compounding story at Ultratech. That's point number 2. Point number 3, on new age businesses, they're also scaling up fast, they're driving earnings, and also there is value optionality at some stage. That's point number 3. And finally, there's a holding company discount that they expect to continue to moderate from here on. In short, they go to wind down by saying that Grasim is one of their top picks. Put this together, the stock is surging away in today's trading session, up close to around 4.5%. The other stock that I'm looking at is Jindal Saw, and I'd given it as one of the stocks of the morning. And the reasoning is that overnight they went ahead and they announced a capex plan in the Middle East. That's in Saudi Arabia, as well as in the United Arab Emirates. Now they've gone ahead and they've announced a couple of projects out there on the same seamless pipes business as well. So the reason that the street is excited about this is the street was concerned about no growth. Now, since they've announced capex in the Middle East, that's what will help them in terms of growth going ahead. Point number 1. Point number 2 is, if you look at the stock price move in the last 6 months, the street, since they were concerned about no growth, the stock was down close to 30% in just 6 months. And point number 3 is on the valuation parameter. It trades at sub 5 times EV upon EBITDA. That's FY27 EBITDA. So valuations as well were supporters. So put these 3 points together, announcing capex, stock had already got slammed, and point number 3, valuations attractive, explains why the street is bidding up the stock, up 10% as we speak.
Ooh, big move on Jindal Saw. Thanks for that, Nigel. Well, with that, we will take a very quick break. Come back on the other side, and it will be time for a special segment of the economy. Today, Lata speaks with Soumyakanti Ghosh, member of Finance Commission, and the PMEAC on the monetary policy and the state of the economy.